The CVD Oscillator Toolkit is a volume-driven market analysis indicator designed to highlight buying and selling pressure that is not directly visible through price action alone. Price shows where the market traded, but volume imbalance helps explain who was in control. This indicator is built around Cumulative Volume Delta, or CVD, and its related measurements to separate aggressive buying from aggressive selling, highlight volume behavior that develops independently of price movement, and expose divergence between price action and underlying volume imbalance behavior. The signals are derived from normalized and smooth volume data rather than simple price-based conditions. So, unlike raw CVD plots, which often drift endlessly and become difficult to interpret across different symbols or sessions, the CVD Oscillator Toolkit normalizes and structures volume data into a stable oscillator format. This allows volume behavior to remain readable and comparable across different market conditions and instruments without being distorted by session length or cumulative drift. It's important to know that this indicator was developed by Flux Charts in collaboration with myself. So the only place to get this indicator is through Flux Charts, and you can visit this indicator's page at vwapwave.com/toolkit. So what is the theory behind this indicator? This indicator is built on the idea that price movement is driven by imbalance, not by candles alone. So every candle represents an interaction between buyers and sellers, while the direction of candle shows which side gained control. Volume reveals the intensity of that effort. The CVD Oscillator Toolkit reconstructs this interaction by estimating buying and selling pressure on each bar, accumulating that imbalance over time, and then normalizing the results so volume behavior can be compared meaningfully across different symbols, sessions, and timeframes. This volume behavior is further structured into directional, momentum, and divergence components, allowing buying and selling pressure to be analyzed from multiple perspectives. So rather than treating volume as a secondary confirmation, the toolkit treats volume delta as the primary source of information, with price acting as a contextual reference. This approach is particularly useful in market conditions where price alone can be misleading. For example, during consolidations where volume pressure may be building beneath the surface, during extensions where price continues to make new highs or lows while buying or selling pressure weakens, or during breakouts that lack sustained volume support. In many cases, shifts in buying and selling pressure can become visible through volume behavior before the price structure visibly updates. So the indicator is designed to surface those changes without attempting to predict outcomes, allowing traders to interpret volume dynamics alongside their own price-based analysis. So the CV Oscillator Toolkit features 10 main features. We have delta volume and CVD core engine. We have normalized CVD oscillator with adaptive coloring. We have CVD cloud, edges, highlight candles, and bands. We offer signals, CVD divergence, flow behavior, and rate of change momentum meter, advanced visualization and theme system. We have input settings, and lastly, we have alerts. Now we're going to break down each one of these 10 one by one. So let's start with the delta volume and CVD core engine. This feature forms the foundation of the entire indicator. So let's start with CVD. CVD is a measure of net buying and selling volume over time. It is built by estimating whether each candle's traded volume was driven primarily by buyers or sellers, and then accumulating that imbalance across consecutive bars. So when buy dominant volume exceeds sell dominant volume, the CVD rises. When sell dominant volume exceeds buyer dominant volume, the CVD falls. Because TradingView does not provide true bid-ask volume data, the indicator infers participation, so buyer versus seller activity, using price behavior within each bar. So each candle is evaluated to determine directional intent. Bars that close higher than they open or otherwise show upward intent, these are treated as buy dominant, while bars that close lower or show downward intent are treated as sell dominant. The candle's volume is then assigned a positive value when buy pressure dominates and a negative value when sell pressure dominates. By accumulating this signed volume, the engine produces a continuous measure of who is applying pressure, independent of candle size or price range. Now, this allows delta volume strength to be analyzed separately from price movement itself. So, throughout this indicator, volume pressure refers to the net effect of delta volume over time. So, how do we interpret CVD? When CVD is rising, buying pressure is more aggressive than selling pressure. When CVD is falling, sellers are exerting greater control. A flat or sideways CVD, this behavior indicates balance or uncertain buyer versus seller activity, where neither side is clearly dominant. One of the most important insights provided by CVD is its relationship to price. So price can continue rising even when CVD declines, suggesting weakening buying pressure and potential distribution. Conversely, price can fall while CVD rises, and this is indicating absorption. This is where selling pressure is being met by opposing buy orders, limiting downside progress despite continued activity. These situations often reveal information that price alone does not clearly communicate. So, for this reason, CVD is especially useful during consolidations, false breakouts, liquidity sweeps, and late stage trend conditions, where price action may appear convincing, while delta volume tells a different story. Let's talk about the long term versus short term volume calculation modes. The indicator supports two volume perspectives. In long-term accumulation mode, delta volume is accumulated continuously, providing a broader view of sustained buying and selling control across sessions or trends. In short-term rolling window mode, delta volume is summed over a fixed rolling window to emphasize local momentum and short-term shifts in buying and selling pressure. Together, these modes allow the same core engine to be used for higher time frame bias analysis, as well as intraday momentum and reversal observation, without changing the underlying logic. So in brief, the longer time frame will be higher time frame perspective. The shorter time frame will be for intraday momentum trading. So how is it calculated? Each candle's volume is first evaluated based on price behavior to determine whether it is buy weighted or sell weighted. That signed volume is then processed in one of two ways, depending on the selected volume calculation mode. In long-term mode, delta volume is accumulated continuously to reflect a broader market pressure over time. In short-term mode, delta volume is summed over a rolling window to emphasize local momentum and shorter horizon shifts. The resulting series forms the raw CVD, which is then used for normalization, smoothing, and signal generation. All calculations rely only on confirmed historical bars, ensuring consistency and non-repainting behavior. In addition to the cumulative CVD calculation, the indicator includes an optional delta volume histogram that displays raw buy-sell imbalance on a per-bar basis. This view highlights short-term volume bursts that may not be immediately reflected in cumulative behavior, such as sudden spikes in buying or selling pressure, absorption events, or volume surges that fail to produce meaningful price movement. Because raw delta volume can be noisy and highly sensitive to short-term fluctuations, the histogram is visually muted by default. So let's talk about what the normalized CVD oscillator is and what is normalization. Normalization is the process of rescaling data so that it can be interpreted consistently over time. In this indicator, normalization transforms accumulated volume delta into a stable oscillator that remains readable across different sessions, symbols, and market conditions. Now, CVD normalization modes, such as adaptive versus relative, the accumulated delta is normalized to create a stable, interpretable oscillator. This process reshapes volume pressure so it can be compared consistently over time without changing how delta volume itself is calculated. In adaptive mode, normalization responds to recent behavior, allowing the oscillator to self-scale as volatility and market conditions change. This keeps the reading responsive and readable across shifting environments. In relative mode, normalization compares current CVD against a fixed historical reference, preserving proportional relationships and volume behavior and making extremes easier to compare over longer structural moves. Now, normalization affects how CVD is interpreted and visualized, not how delta volume is calculated. In both modes, the same underlying volume logic is used, only the framing and scaling of that data is what changes. The CVD Oscillator Toolkit presents normalized volume behavior as a bounded oscillator that preserves directional intent while preventing cumulative drift. Rather than emphasizing the absolute size of volume imbalance, the oscillator focuses on where current buying and selling pressure stands relative to recent behavior. This structure keeps volume pressure interpretable across different market conditions, allowing the oscillator to remain comparable across assets and timeframes. So, how do you interpret the normalized CVD oscillator? The oscillator revolves around a central equilibrium level, represented by the zero line. When the oscillator is above zero, net buying pressure dominates. When it is below zero, net selling pressure dominates. Transitions across the zero line indicate a shift in volume control rather than a price-based event. The depth of the oscillator's movement provides additional context. So, shallow oscillations reflect weak or hesitant order flow pressure, while deeper extensions suggest stronger conviction from one side of the market. Periods where the oscillator compresses near the zero line often indicate balance, absorption, or indecision between buyers and sellers. Because the oscillator is smooth, it emphasizes sustained volume behavior rather than reacting to single bar fluctuations or short-lived volume spikes. So, how is it calculated? Raw cumulative volume delta is first evaluated over a configurable look-back window to establish recent volume pressure behavior. A momentum-based normalization process is then applied to compress extreme values. This prevents the oscillator from drifting or becoming distorted during high volume periods. To further refine the signal, multiple smoothing passes are used to reduce noise while still preserving meaningful directional turns. The result is a stable oscillator centered around zero, designed to behave consistently across different symbols, sessions, and timeframes. So this structure avoids infinite drift, minimizes session bias, and allows volume pressure dynamics to remain comparable across instruments without relying on fixed thresholds. The indicator also has adaptive coloring and directional gradients. So the oscillator is not plotted as a static line or a simple histogram. Instead, it uses adaptive coloring to communicate both direction and intensity of volume pressure through visual cues. Rather than relying on binary green-red coloring, the indicator applies smooth gradient transitions, strength-weighted opacity, and direction-aware color, and this logic to reflect how volume pressure evolves. So this visual design allows changes in volume behavior such as acceleration, deceleration, or momentum fatigue. This can be identified quickly without requiring precise numerical interpretation. So color intensity increases as pressure strengthens and fades as pressure weakens. This helps maintain situational awareness even during fast-moving conditions. So how do you interpret the coloring? The oscillator uses momentum-based coloring to reflect changes in volume pressure, strength, and direction. The colors respond to acceleration and deceleration in volume pressure rather than simple position alone. Brighter, more saturated colors indicate stronger momentum and expanding buying or selling pressure, while muted or fading colors reflect slowing momentum and weakening pressure. The coloring does not generate signals and should not be read as visual context that complements the oscillator structure, helping identify momentum shifts, continuation, and exhaustion at a glance. This is the CVD edges, clouds, and highlight candles. And we'll start with the CVD edges. This feature adds a thin directional outline around the oscillator body. Now, this is designed to emphasize the current directional volume bias without overpowering the main visual structure. The edge acts as a subtle visual guide, reinforcing directional dominance while keeping the focus on the oscillator itself. By separating the outline from the oscillator's fill or columns, the CVD edges make directional bias easier to identify at a glance, particularly in situations where histogram columns overlap or visual density increases. This feature is intended to enhance readability and orientation, not to introduce additional signals or conditions. The CVD clouds add a soft envelope above and below the oscillator to provide visual context around the volume behavior itself. These clouds represent upper and lower volume pressure zones derived from the oscillator, helping frame how volume pressure expands or contracts around the core signal. So when the cloud expands, it reflects increasing volume commitment and stronger involvement from one side of the market. When the cloud compresses, it indicates diminishing conviction and reduced pressure intensity. A flip in the cloud structure reflects a change in volume control rather than a price-based event. CVD clouds are designed to provide context, not signals. They help answer a simple but important question: is the current move supported by volume effort, or is pressure fading beneath the surface? So with the highlight candles, instead of rendering the oscillator as a simple line or a histogram, this feature displays it using candle-style bodies. So each oscillator candle visually represents the underlying volume behavior, conveying direction, strength, and momentum continuity in a format that closely resembles price action. So larger candle bodies indicate stronger and more sustained volume pressure, while smaller bodies reflect indecision, balance, or transitional phases. The sequences of candles with consistent coloring help visualize directional continuity in pressure flow, making it easier to distinguish persistent pressure from short-lived fluctuations. The upper and lower bands are simple visual background guides drawn above and below the oscillator. They do not generate signals, thresholds, or analytical conditions. Their only purpose is to make the current CVD state easier to read at a glance. When the oscillator is above zero, the upper band is highlighted to reflect bullish volume pressure. When it is below zero, the lower band is highlighted to reflect bearish volume pressure. The inactive side remains muted. These bands do not represent overbought or oversold conditions and should not be used for entries or exits. They exist purely to improve orientation and reduce visual effort when reading the oscillator. Now, the indicator includes an optional signal system designed to respond to changes in volume pressure. So rather than relying solely on price-based conditions such as moving average crossovers, signals are generated based on defined CVD behavior and volume flow logic, allowing volume dynamics to be evaluated directly instead of inferred from price alone. Signals can be displayed directly within the oscillator pane, overlaid on the main price chart, or shown in both locations simultaneously. In this indicator, directional momentum refers to the direction and slope of the normalized CVD oscillator itself, not price momentum. A change in directional momentum occurs when the CVD oscillator shifts from rising to falling, or from falling to rising. It has different signal modes and supports two independent signal philosophies selected by the user. Each mode interprets volume pressure changes differently and is suited to different market conditions. So let's start with zero-line state shifts. In this mode, signals are generated when the normalized CVD oscillator crosses its central equilibrium level. A cross above the zero line represents a transition from net selling pressure to net buying pressure, while a cross below zero represents a transition from net buying pressure to net selling pressure. From an interpretive standpoint, a bullish signal indicates that buying volume pressure has become dominant, while a bearish signal indicates that volume selling pressure has taken control. These signals are most useful during transitions in market behavior, such as when markets move from consolidation into expansion, or when price structure begins to compress ahead of directional move. Rather than reacting to price structure alone, this mode highlights shifts in buying and selling pressure derived directly from volume behavior itself. Now, we also have directional momentum and thresholds. So instead of waiting for the CVD oscillator to cross the zero line, this mode generates signals when there is a switch in directional momentum. A directional switch occurs when the CVD oscillator's momentum has been moving in one direction and then turns to move in the opposite direction. Every signal in this mode begins with a confirmed change in direction. Because directional momentum can flip quite frequently, especially during ranging or low conviction conditions, this mode incorporates user-defined thresholds to control which direction changes are allowed to generate signals. The thresholds act as a filter, ensuring that only momentum reversals occurring from a sufficient depth are considered, while shallow or minor flips are going to be ignored. So here's how it works. For a bullish signal to be generated, two conditions must be met. First, the CVD oscillator must be below the user-defined bullish threshold. Second, directional momentum must switch from downward to upward. Only when both conditions occur together is a bullish signal produced. If momentum turns upward while the oscillator is above the bullish threshold, no signal is generated. The same logic applies on the bearish side. A bearish signal requires the oscillator to be above the bearish threshold and direction momentum to switch from upward to downward. Momentum reversals that occur closer to equilibrium are filtered out. Now, how do you interpret these signals? A bullish signal below zero indicates that directional momentum has switched from bearish to bullish and that the reversal occurred below the bullish threshold. A bearish signal above zero indicates that directional momentum has switched from bullish to bearish and that the reversal occurred above the bearish threshold. In both cases, the signal simply means that the direction changed and that the threshold filter was satisfied. The mode does not attempt to predict outcomes or replace price-based confirmation, but instead highlights filtered momentum shifts in volume behavior. Now, the CVD divergence detection feature identifies situations where price continues to push toward new extremes while volume pressure weakens or moves in the opposite direction. This behavior often reflects absorption, distribution, or exhaustion that is not immediately obvious from price action alone. Now, there are different types of divergences. A bearish divergence occurs when the price pushes higher, but the CVD fails to confirm the move or forms a lower high, indicating weakening buying pressure behind the advanced. A bullish divergence occurs when price pushes lower while CVD fails to confirm or forms a higher low, suggesting that selling pressure is losing strength. Divergences are evaluated only near meaningful swing points and after confirmation. This filtering helps reduce noise and avoids highlighting minor or premature divergence conditions. So, how do you interpret divergences? Divergences can indicate that momentum may be weakening, control between buyers and sellers may be shifting, or that the risk-reward profile of the current move is changing. Divergences provide insight into underlying volume behavior, but do not replace confirmation from price. Now, there is a swing reference source, so the indicator allows divergence detection to be anchored to either volume structure, like CVD swings, or price structure, such as price swings. This distinction matters because CVD and price often pivot at different times. So anchoring divergences to the wrong structure can produce misleading results. So by allowing the user to choose the reference source, the divergence system adapts more effectively to trending conditions. We'll have mean reverting environments or periods of elevated volatility. Let's talk a little bit about how these divergences are calculated. So the indicator identifies significant swing points and then compares the relationship between price behavior and CVD behavior at those locations. So divergence conditions are validated before being displayed, and only confirmed divergences are plotted. To prevent clutter, the only most recent divergences are shown on the chart. Older divergences markings are automatically removed as new ones form. The indicator allows divergences and signals to be displayed either within the oscillator pane or directly on the main price chart. So using the oscillator only view is well suited for volume behavior analysis and directional bias, while displaying signals on divergences on the main chart provides a clear execution context alongside price structure itself. So this ensures that volume insights can be adapted to different workflows without changing the underlying logic. And here's an example of the price divergences put onto the chart with the second pane having it on the oscillator as well. Now let's talk about flow behavior. This feature group highlights situations where price behavior and CVD behavior begin to separate without relying on traditional swing point divergence logic. So we have absorption, and absorption highlights candles where price continues to advance or decline while CVD pressure moves against that direction. So, in simple terms, absorption reflects situations where aggressive buying or selling is being met by absorbed and opposing volume, preventing volume pressure from confirming the price move. This behavior often appears during late stage trends, near range boundaries or very important setup locations, and around liquidity driven extensions. Now, absorption highlights do not predict reversals. They provide context when volume pressure is no longer aligned with price movement. Absorption is identified through disagreement between price progression and CVD behavior, not by raw volume spikes alone. Directional divergence identifies moments where price continues to extend in one direction while CVD momentum shifts or weakens to the opposite direction. So, unlike classic divergence tools, this behavior does not require confirmed swing highs or lows. It focuses purely on directional disagreement between price and volume pressure, allowing early detection of weakening moves or hidden opposition beneath continued price expansion. So, directional divergence focuses on ongoing disagreement without swing confirmation, while CVD divergence evaluates confirmed swing based divergence. We also have directional anchor price. So an optional directional anchor line can be plotted to mark the price level at the bar where CVD last changed direction. This level serves as a visual reference, allowing traders to observe how the price behaves after a shift in the underlying CVD direction, without introducing new signals or conditions. So these tools are designed to complement the core oscillator by visually exposing price volume disagreement. We also have the rate of change, or ROC, momentum meter. So the rate of change ROC momentum meter measures how quickly the CVD oscillator itself is accelerating or decelerating. When the oscillator describes directional volume pressure, the ROC meter focuses on a different dimension, whether volume pressure is gaining speed or losing momentum. This distinction is important because directional pressure and momentum strength do not always change at the same time. Trends can lose momentum without immediately reversing direction, and volume shifts often begin with changes in acceleration rather than visible price structure breaks. So the ROC meter is designed to surface those changes in volume momentum without replacing the oscillator's directional context. So how do you interpret the ROC meter? The ROC meter is displayed as a vertical gradient bar positioned alongside the oscillator pane. It is intentionally placed in the periphery to provide continuous momentum awareness without interfering with price action or the oscillator itself. A dynamic label marks the current ROC position, allowing quick reference without drawing focus away from the main analysis. When the ROC reading is positioned higher on the meter, volume acceleration is stronger. When it is positioned lower, acceleration is weaker. Readings near the center indicate balanced conditions. So sustained high ROC readings often accompany strong trends, while reflecting continued acceleration and volume pressure. As momentum fades, ROC readings contract, indicating slowing acceleration, even if directional pressure has not yet reversed. So how is the oscillator ROC calculated? The oscillator's rate of change is measured over a short look-back period and then normalized to prevent extreme spikes. The resulting values are mapped to a bounded vertical scale, ensuring the meter remains stable, comparable across assets, and resistant to distortion during periods of elevated volatility. And here is what a rate of change momentum exhaustion looks like on the meter at the bottom. The indicator includes a multiple built-in color themes. Themes can be adjusted to suit dark or light chart backgrounds, varying screen brightness levels, and long trading sessions where visual comfort becomes important. Each theme affects key visual elements such as bullish and bearish colors, gradient intensity, cloud opacity, and overall contrast. There's also module visual controls. So every major visual component of the indicator can be enabled or disabled independently. This allows users to tailor the display to their preferred workflow and level of detail. This includes elements such as the delta histogram, the oscillator columns, highlight candles, edges, clouds, upper lower bands, the ROC momentum meter, and threshold reference lines. Now, the CVD Oscillator Toolkit includes full alert functionality using any alert, allowing users to receive notifications in real time for all major model components and signal events. Users can enable or disable each alert type in the alert section of the settings, and after selecting which alerts they want active, they can create a single TradingView alert using the any alert condition. All alerts are triggered only after confirmation, not on provisional or forming conditions. Lastly, I want to talk about the uniqueness of this tool. The CVD Oscillator Toolkit focuses on identifying volume-driven behavior rather than simply plotting cumulative volume. In addition to normalized CVD, it highlights absorption candles, directional divergences, directional anchor price levels, and a rate of change momentum meter that tracks acceleration and deceleration in volume pressure. Together, these components expose situations where price continues in one direction while volume pressure weakens, stalls, or reverses beneath the surface. The CVD toolkit emphasizes interpretation over signal quantity, structuring volume behavior into momentum, divergence, and flow-based components that complement price analysis without attempting to replace it. So looking forward to hearing everybody's review of the oscillator. I know there's a lot in this video. Start using it with your trades, and be sure to like this video and let us know how it's working for you in the comments below, and we'll see you in the next video.